Hello again, everybody, and welcome back to the Accelerator with Michael Conniff. That's me. We are here for founders, starters, entrepreneurs, and also venture capitalists, angels, family offices, investment firms. It's great to be here. I think we've done close to 50 of these podcasts. And today we are very happy to say we are joined by Apoorva Ruparel, who is a general partner at Venture Rock in California. Hello, Apoorva. Welcome to the program.
Hi, Michael. Thank you very much for having me. I've listened to the other podcasts that you've done. Very, very intrigued and happy to be here.
Yeah, and right back at you. I've actually just been listening to two podcasts that you did, so very interesting. And actually, I think based on our previous conversation in those podcasts, some of the things you've had me thinking about, that you're actually um, don't get embarrassed if I say that, but I think you're one of the intellectuals of the venture community. I think you give things a lot of thought and you dive deep, and
Thank you.
that's meant as a compliment. So let's dive right in. I wanted to jump right to something you really know a lot about, which is the transition from Web 2 to Web 3. And I think Web 2 is pretty well defined. It's the web as we know it today, more or less. It's the five companies that dominate that space. But I feel, and I've done probably 5 or 10 podcasts on this, and I still feel that Web3 is completely misunderstood, underestimated, as George Bush would say, misunderestimated. Can we start this by a description on your part of exactly what is Web3 and how you define it at Venture Rock?
So, Web3 truly is definitely the next era of computing. We are still very early in the game. I think Web3 will solve the most fundamental problems eventually of decentralization, not having middlemen, digital currency, which is not, kind of backed by bonds or bullion or any of that, and truly borderless nations, is what Web3 is about. I mean, if we go deeper in terms of technology, I don't think it makes sense for this audience, but fundamentally, it is something in the building which currently only has one application layer, which is like the tokens, if they are non fungible or fungible. But fundamentally, we are just starting off on the protocols and the infrastructure layer, and eventually the applications will come out. There are few simple like NFTs. Just to give you an example, we don't only think of NFTs as uh, collectibles or art. NFTs can pretty much be barcodes on whiskey bottles to track them, from manufacturing right up to who's using it. But so that's where we are headed. Unique barcodes can be NFTs, but I'm saying we've still not, nobody has still kind of unlocked that potential because of the fact that there are lots of challenges. And let's talk about the challenges and how we look at transition. Like today, if you look at you, Michael, being, I mean, from our conversation, I know how much experience you've had. You've seen all the eras, right? From, let's
Oh, I
say,
made a lot of
radio
them
to today.
myself, Apoorva. I made a lot of them myself.
Yeah. So I'm saying you've seen the transformation from the radio or the wired telephone world to today. So have I. But I'm saying majority of the population is still not able to even unlock the potential of Web 2 in form of usage. So like my parents still struggle with internet banking, right? A lot of them do. And we are already talking about Web 3, where even people like me struggle unless I really hone my skills and upskill myself. You need to have a, wallet, a MetaMask wallet, which probably is the most used, but there are tons of wallets to kind of choose from. Um, and storage is still a big challenge, right? The IPFS is still not solving a lot of storage issues. So I'm saying Web3 is, all the goods are still far away. People have still not been able to, kind of view that because applications are very few. And there is a huge challenge in terms of transition of Web 2 to Web 3. So companies which will be focused on creating simpler uses of wallets, make it much more like what people are used to, in terms of user experience, in terms of not making errors. Like, I mean, billions of dollars have been lost just because people have transferred, from different wallets to different wallets, which do not kind of talk to each other yet. So I'm saying these are clear signs that we are a little bit far away from Web3 yet. But it's a promising technology. We should watch out for it. We should continuously learn as the infrastructure layer is being built.
And you have a just announced a $75 million sports and media and tech fund that's going to be looking at this quite closely. But to kind of zero in on this a bit, you have a company, I believe, have invested in a company called UNL. And this company is involved in what you would call the democratization of ownership. And this seems to be very important to what you're doing. And I guess I have a two-part question. The first part is democratization of ownership antithetical to what venture capital has been traditionally, which is a few people get really rich in the bargain? And also, is it is it that let's focus on that because that really confuses me. How can a venture firm like Venture Rock, live up to its whatever promises it makes to limited partners or to other investors or to its own partners, and still create this distribution democratization of wealth? That seems a pretty tough trick to me.
Yeah, it is. So I'm saying if you look at traditionally, uh, capitalism per se, right? Like, it started off with
Hmm.
acquiring land in pre 1900s, and then it was about real estate, and it made a lot of billionaires. And then when the real value assets kind of, you know um were pretty much satiated, valuations crept up, and United States was always forward in terms of research and development. And with the Silicon Valley and the fund availability from defense organizations, it was very clear that innovation can be valued at much more from a future wealth or future valuation perspective, the future value of money. And that's how the whole startup scene and venture capital came up, right? I mean, that's what history shows very clearly, that United States wanted to kind of be the dominant economy, owner, and that's why the startup venture capital system was pretty much invented. That's
Hmm.
that's the reality that I've kind of learned. Having said that, of course, like in any business, you have to be truly capitalistic, and there is nothing wrong or right. That's the way I kind of, at least, you know, not get confused or tell myself that there are nuances which are good pretty much in everything that you build, but you can reduce wastage, you can reduce negativities. That's how we look at it. So let's say tier one VCs, like you named, Andreessen Horowitz, Sequoia, these guys are, of course, returning anywhere between 38 to 46% kind of IRRs to their LPs, which is a great thing. But then, to be able to do that, you need to pick out the best founders, pick out the right space, pick out the leaders in that space, and focus all your follow on rounds or the large part of the capital that you've raised to gain the maximum returns. So they would basically back 2 out of 10 of their investments all the way to IPO, and that's where they make sometimes 500 to 1000x returns as well.
Hmm.
And that's what defines them. And if that's what defines them, the only output or the product out of that is less and less limited partners get access to that fund, because they are proven, and the wealthier LPs kind of pretty much subscribe to the whole round, right? And there is a tipping point in there. On the other side, we believe in fundamentals. So what is defined as success in venture capital? I mean, and you need to break that down always. So
Hmm.
in our view, 76% of startups fail at a very early stage, and there are clear reasons for it. The reasons are because most of the time founders are raising funds. They raise 3 to 4 checks pretty much before they raise Series A. Series A is usually the kind of, how do you call it? the validation of somebody's business, and that MVP has been done, and now there's a clear product market fit, founder market fit, and thus you kind of raise the Series A round, and then you scale your business. But most of the founders don't even reach there because there are accelerators who are again trying to add value. No resentment or any kind of disrespect there. They write small checks. They take 6 to 7% of the equity, and then the founders have to raise more till they reach the Series A stage. The way we are looking at venture capital is, yeah, you got to be capitalism oriented, so that only then will the LPs make the returns that we have promised them to.
Mm-hmm.
But there are ways to increase success, because if you look at venture capital only from a um, business perspective, it was earlier far and few, and now it's pretty much everybody, which fundamentally drives economies of the world, which fundamentally drives SMBs of the world,
Mm-hmm.
right? Which drives job counts. Now it's significant, right? Startups employ, I think, 35 to 40%, people in most of the emerging countries. So when you look at it from that perspective, you have to reduce wastage and you have to ensure that there is increased success, right?
Mm-hmm.
And that's why we think it is going to be okay to build ventures far and few. So we invest in about 5 to 6 ventures in a year, every year. Our fund structures are evergreen, so that whenever there is a realization of capital in terms of exits, we return the money back to the LPs so that they are more encouraged to invest.
Mm-hmm.
We invest 2 to 2.5 million right at the light bulb moment of the problem solution statement stage, which is again tough for us to find. But as we grow and as our name is known more, there will be a lot of incoming, which is at that stage, when a founder thinks about a problem solution statement and kind of reaches out to us. Um, and the reason that we commit 2 to 2.5 million at that stage is that ideally the founder is then only and only busy building the business, the MVP, the acceleration to the Series A, which fundamentally would come when the product market fit would happen, which means early stage traction. Not only do we do that, we also have devised this 72 milestone program,
Mm-hmm.
which immerses the founders more at the acceleration stage into their own business. Because when most of the founders today, if you will, love their business, and they have all the rights to, but they have not been questioned about a lot of dynamics that would play in a success of a startup. Things like, what happens if you disagree with your co-founder? What happens if there is an emergency and the co-founder has to leave? What happens when a COVID-19 pandemic happens? What are the customers using today, apart, I mean, from the solution that you're building, what are they using today, and how are your solutions, 3x 4x of customer experience? Have you interviewed these customers? Why would they pay for your product? Those nuances which kind of are there somewhere in the subconscious but are not really asked or documented. And with that, the founders feel much more comfortable, confident on their own business, and thus they thrive. And our job is, so what we are saying is, we want to create 100% success at the stage where everybody fails the most. Nobody's talking about that, and that's more stunning than anything else.
Oh,
Why is
I want to say that again. So you want to you just delve down into that, if you would. The point where most startups fail is where you have this great focus. So, and how would you describe that point precisely, where most startups fail, and how you address it?
yeah, but most so let's first say why startups fail.
Mm-hmm.
Most of them run out of funding. The second most reason is the product or the idea or the solution that they had made or envisaged will be used by everybody was just an idea. It was nothing that people were looking for, right? Third, the pricing was too big. Fourth, the viability of the business and the fundability and scale is not possible. So these are some of the ideas. And how do people look at filtering those startups? The way to do it is, when you apply to an accelerator, some get selected, some don't, right? Then when you go to the next round, pre-seed round, some founders get funded because of all the reasons I stated, but most of them fail because they're not able to raise funds. So our thesis is, sure, we will filter problem solution statements, and I'll after this I'll follow up with the thesis that we have on how we look at building a successful portfolio. But we filter out those problem solution statements, which means now we are 100% sure that we want to back this founder. Then you write the biggest check that a founder would usually take 3 or 4 rounds of investment sourcing, and then all the other risk factors, like I was saying, pricing, viability, fundability, scalability, these get solved with the program that we have built for the startup founders. And then we ensure that we kind of start giving insight into our partner Series A VC ecosystem right at what we call phase C of the four phases in how the startup is built, so that by the time they graduate, 18 to 24 months, they would be able to then already get the investment that they were looking for. And if mostly, I'm not saying it's 100%, but like 36% failures happen after Series A. So, I mean, if 100 startups kind of cross the Series A graduation, we've seen that 64 of them kind of move to the next stage,
Mm-hmm.
which is 24 when it is in the early stage. So if you were just able to make sure that every portfolio that you invest in crosses the Series A stage, there's less wastage, there's more jobs, it's better for the economy, and it still serves the main purpose of venture capital, which is capitalism.
Yeah.
So that's the
Well,
way we think about it.
Apoorva, speaking of capitalism, for to write a $2.5 million check at the light bulb stage, um, I would think that you would take an equity stake commensurate. That's a big commitment. What's the range of that? I'm sure it varies, but what kind of a stake do you have in a company when you once you've decided you're going to put them through that 72 step plan?
So we usually take positions. I mean, the lowest position that we would have ever taken is 18, but the highest
Hmm.
position that we would ever have taken is 24,
Okay,
right?
so there's
So it's
there's no
not
range.
predatory.
Yeah.
It's not predatory at all. It is very founder friendly. The other thing we do for, kind of being responsible towards our LPs is when we make this commitment of 2.5 million or so, 2 to 2.5 million, sometimes we also have gone to 3, is we commit to the investment and we will never back out because it's a binding commitment, an agreement.
Hmm.
And then we divide that investment into 4 phases, which are spread across through those 72 milestones. So at phase A, you would get, let's say, a $250,000 right now to
Hmm.
cross the first 18 milestones, which are fundamentally tick marks, not MRR, not ARR,
Hmm.
nothing to do with matrix of the business, but it's just to do things, right? And then as soon as you finish that, you get the next 750K. So it's pretty much like 4 rounds that you get. All you have to do is document your business well,
Uh-huh.
and that way the founders get much more acquainted to their own business more than they think they do. At the same time, LPs know that we are very, very clear, we are strict, at the same time, you know very considerate about the investments that we make on their behalf in companies to create more success.
And so yeah, I mean it's fascinating, and it sounds like a wonderful option for founders who are lucky enough to get to work with you. But on the Web.3 side and the democratization of wealth, if I could segue back to that just for a moment, um, I know that with you have there's a I think it comes down to the applications, doesn't it? Because I think one of the reasons why Web3 is so hard to understand is that a lot of people think it's NFTs or tokens or non-fungible tokens. Some people are familiar with the blockchain. A lot of people are familiar, but there's the applications are kind of wanting. It reminds me a little bit when at the beginning of Web 1, and actually before that, at the beginning of the personal computer, almost all the talk was about what's the killer app? What's the killer app? What's the killer app that's going to make everybody have to have a computer? And can you guess what the killer app turned out to be?
Not really.
Spreadsheet. First
Ah,
Lotus 1, 2, 3, then Excel. Everybody had to have it. It was much better than by hand. you know, so I feel that way here. I know you do have an application that you're working on whereby, well, I'll let you explain it. It has to do with mapping and getting people to get responsibility for a certain, their, I guess you'd say, their tiny corner of the world.
yeah,
How does that work?
absolutely.
How does that
So,
work?
um, first, let me take you through how we look at the portfolio building, which would also add to the success, and then I'll take you through the UNL
Yes, that's fine.
story. So we believe that the capital that we raise from LPs, and we invest our own, is the financial capital. The financial capital then should be utilized to build human capital, which is of course the founders and the teams and the industry professional network that we have, and us, which is VentureRock's team. And that
Mm,
we should then focus to build the infrastructure capital. What is infrastructure capital? So, I
mm,
mean, traditionally, historically, you've known people who made roads and railways and ports and owned those, um, made the most riches, because once you own the infrastructure, you can build your own application on top of it and have others build applications on top of it, right? And
mhm,
that generates a lot of data capital, which gives you all the nuances to further build out on that infrastructure layer or the related application. That's how we think about portfolio building, and our portfolios are modular. And now I'll give you an insight into how we thought through that and how we built UNL and then the other ancillary organizations around it. So, when the founder of UNL, who's also one of the founders of VentureRock, by the way, he was the first entrepreneur in residence
mm,
who built out as a founder and CEO UNL. The problem is multifold, but it starts from the core tech stack. So if you see latitude and longitude as a
mm,
technology was built by Google, in terms of mapping and the other maps which were existing pre-Google, but that was the only way to pin a location.
mm,
Now, in developed worlds like United States or Europe, that has still over a period of time matured because the technology has been in use for a long time. The planning which was done in terms of zip codes, etc., were also very, at least much more mature than the emerging worlds today, right? So, but when you go to Indonesia, Singapore, India, Middle East, Egypt, right, the lat long infrastructure doesn't work because it's not accurate. The accuracy is 62 to 63%, which might be around in the range of 78 to 82% here in the United States or in developed markets,
mm.
right? So when you go from place A to place B, if the geocoding is not accurate, drivers would get lost, which would wastage of gasoline, more carbon footprint, their loss of labor, the costs of goods delivered is much more higher. I mean, today in Southeast Asia and India, the cost of goods, 53% or 54% of goods costs are in deliveries.
Wow.
So imagine how much you can reduce for the end customer if you are able to deliver accurately, and it's all because of this wastage. So the vision for UNL was first correct this. And how do you do that? The way to do that is you have to reinvent the way geocoding is done. And that's why ideally we want to be fully map agnostic, but you got to start somewhere. So we work with Here Technologies, which is probably the number two and the number one in automobile navigation mapping in the world. They came from the Nokia Navtech world, but now they are branded
Mm.
as Here Technologies. And then the open street maps, right? Because Google would definitely not give us access to it. So
Mm.
we want to be able to divide the entire map into 1 by 1 centimeter squares, which we have done. And all those cells are programmable cells. So you can pretty much have one cell have their own IP address or a DNS or a domain name, like, you know, like we have on the web. And then these are cells which, because they are databases, they can also understand and, hold data and autocorrect themselves. To give you the best example, today my parents live, in a city called Thane, which is in Mumbai, near Mumbai, in Maharashtra, in India. The address is apartment number, name of the building, parallel to the water pipeline, opposite this bus stop, behind the palm tree. You know what I'm saying? Now, how do you geocode this address?
Right, right.
So that, and there are many like that across Middle East, Dubai, Saudi, even, I mean, Egypt, Indonesia, Malaysia. Everybody has these kind of problems. So with geocoding, we have already been able to demonstrate in a certain customers 93% accuracy. Now that's humongous, because that would mean 30 to 40% cost savings on what you're delivering. Then how do you make it better? So point of interest data, right? So when somebody, let's say a Uber Eats driver, is delivering food for the first time in my locality,
Mhm.
they would also keep improving the point of interest data, because that's their job. Uber kind of gives them, incentivizes them to say, hey, you know what, park here. This is the closest to the location.
Mhm.
Take the first elevator, not the second one, and so on and so forth. Now, this point of interest data, although Uber updates it, is still owned by Google.
Ah,
Uber can never monetize it, right? So what we are also doing is we want to democratize exactly what Apple did, right? Apple democratized their phone and the operating software by giving it out to all the apps, I mean, all the application developers who can then put it on App Store. What we want to do is we want to be able to say, hey guys, come on, put the point of interest data, and then kind of publish it on the Map Store so that you can monetize on all the time that you put in. So imagine a pharmacy delivery company in Kenya would then buy off this data from the grocery delivery company. So they wouldn't lose 5, 6, 7, 8 months of point of interest data to become more and more efficient. Similarly, a hobbyist would be able to go to 1,400 food trucks and say, hey, here's my entire journey to all these food trucks with all my reviews and stuff, and kind of save it, sorry, rather, monetize it on the Map Store. So that's the second part of our eventual ambition and goal. And third is, we are pretty much building the digital twin of the real world on the map. Then the Web3 infrastructure comes in, where you can have more ownership. You can
mhm.
basically say, from these many centimeter squares are my house, and that is registered on my name, my identity. And then let's say if I sell it, smart contracts. So we are building that infrastructure layer, readiness for Web3 when it comes.
No. Wow.
So that's UNL. Now, on top of UNL, the other venture that we built is called InsurTech, which does dynamic risk pricing for insurance companies on basis of UNL. So once you have so much accuracy, you can then divide zip codes. And just to give you a simple example, there's a less risk of if there's less risk of forest fires or earthquakes or
Mhm.
volcanoes, then the
Mhm.
premium prices can go down, which means everybody can afford it.
Yeah.
Currently, it's the same premium across wherever you own a house, right? So those kind of problems is what we aim to solve, and that's why we build these modular ventures.
Yeah. No, it's fascinating, and I feel like we are just scratching the surface. With Apoorva Ruparel. He is the general partner at Venture Rock in California. He's in the San Diego area. I'd love to have you back, and because I know your personal background, all your exits, all your success is also fascinating, and you've lived all over the world. purposefully. And this is this latest approach and thesis, I think, seems pretty cool. So thank you so much for being with us, Apoorva. Appreciate it.
Thank you, Michael.
This
Happy to be
is,
here.
yeah,
Have a good
thank
one.
you so much. This has been Con Games. I'm Michael Conniff. We are here once a week, updated podcasts on all the major platforms, Apple, Amazon, Audible, and also on YouTube. You can follow me on Twitter at Michael Conniff, MichaelConnonniff. Also, my website, michaelconniff.com. Make sure to leave a review, maybe give us a nice rating. We would appreciate that. And in the meantime, we'll be back before you know it with more from the Accelerator. Thanks for listening.